Hi everyone, this is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has decades of experience working in many different jobs in the oil and natural gas industry. He's also a doctorate, and he has lots of contacts at the highest level in the oil and natural gas industry, and I love to have him on every couple months to talk about the oil and natural gas market. Dr. Kent Morris, thank you for joining me again.
Well, it's a pleasure, Jason.
Now, Kent, there's a lot of things going on in the oil market that I would say the average person is kind of scratching their heads at, because we see the low oil price, and yet we see record amounts of production coming out. I'm looking on oilprice.com now, and I'm seeing stories about record production coming from the Saudis. We know Iran wants to increase production. Why do you think these countries are increasing production with the oil price, still pretty low?
Well, we have to understand that everything here has to be taken in balance. In point of fact, we have oil prices today that are over 70% higher than they were at their low point for the year back on, I think, on February 11th. And they're up now over 20% for this month. We have most projections indicating that the average barrel price of oil is going to be in excess of $50 by the time we get to midsummer, and maybe even $60 or more by the end of the year. This is not a normal supply-demand situation. There is a new balance that's being formed internationally. And that balance is a result of having more documented excess extractable reserves than we've ever had. This remains a supply-demand situation, but for the first time in memory, supply is not an issue. We know we have additional supply if we need it. So that's put a perspective in terms of what this market looks like. The reason why the production has been increasing, and in point of fact, it's beginning to start leveling off for a couple of reasons. First of all, the Russians went well over 10 million barrels a day in January. They've been attempting to sustain that, but their field situation is going to preclude them from being able to maintain that level of production much longer. They have some significant problems in their aging basins, and they have insufficient capital to be able to start expanding their production into new and very expensive areas. So that's number one. Number two, the Saudis, of course, can probably raise their production to 10.5 or even 11 million barrels a day and keep it there for a while. But that now constitutes just about all that remains in the world of immediately available additional volume. When we talk about excess extractable reserves, we're talking about reserves that can be put on the market, but not immediately. The Saudis are the ones that are balancing the market there. In terms of the Iranians, I've written a lot about the Iranians. The Iranians, of course, want to increase their production and exports to the levels they had prior to the imposition of Western sanctions. That means they essentially want to go a bit above 4 million barrels a day in production, and to do that within the next couple of months. That is likely to be reachable. The problem, once again, with the Saudis is that they can't sustain it for the simple reason that their field shortcomings are even more acute than anyone else's. Their pressure is declining considerably at aged fields. They have all manner of infrastructure difficulties. Without a considerable amount of new foreign investment and foreign technical expertise coming into Iran, they simply can't sustain the higher levels. And that ends up being a protracted domestic political mess in Iran. On 3 occasions, Tehran has attempted to set up a meeting in the city, the financial district of London, to begin talking about improving contract arrangements to entice foreign investors into the country. And on all 3 occasions, they've had to cancel those meetings because there's no consensus at home about how to proceed. Under the current constitution and statute in Iran, foreigners cannot own either land or any portion of raw materials. That means you can't enter into a joint venture. You can't have a foreign company coming in with the right to book any of the reserves on their books to improve their overall stock value. You end up with these buyback provisions, which are some of the most torturous and unacceptable contracts available in the world to negotiate. And so the Iranians right now are between a rock and a hard place. They're pretty much prevented by their domestic situation from being able to attain the levels that they're espousing to. Finally, when we talk about American production, and remember, the Americans are never at a meeting like Doha. We're not going to be represented at the next meeting in Moscow for a very simple reason. Unlike all these other major producers in the world, we do not have central government control over oil policy in the United States in terms of oil production policy, and we don't have national oil companies. So there's no easy way that you can get into the American market and be able to have an immediate result. We have in the U.S. Declined below 9 million barrels a day production for the first time in quite some time. And we're going to see a leveling off of production in the U.S. for a couple of reasons. The most important is that virtually the vast majority of American producers, most of them being small companies, have been cash poor now for quite some time. And when the price of oil was higher, that didn't make any difference because you simply rolled over your current lines of credit to pay for your next operational stage. Well, you can't do that anymore because oil oil debt is now the highest level of high risk or junk bonds. And nobody out there is going to be able to refinance their debt at less than about 20% annualized interest. And that's simply unsustainable. So the crush of that is cutting down excess production. We also have the situation in which a considerable amount of foreign capital expenditures have been cut in the United States moving forward. So there's less available there to expand fields in what is still not a very promising pricing environment. You have to remember, Jason, that in order for most of the deeper fracked, horizontal, shale, or tight oil formations to be drilled at all, you need an average price of at least $55 a barrel, and with most of these, you need it in excess of 60. And we don't have anything close to that yet, so we're not going to be kicking any of this additional production. The final thing to remember in the United States is look very carefully at the overall figures of new wells being drilled in the United States, because a widening number of those wells are actually DUCs, DUCs. These are drilled but uncompleted wells. These are wells that are being drilled that will be filled out, will be completed later by operating companies to take up the volume of declining production from older wells. So these new wells actually will not be increasing very much, if any, to the overall production volume in the U.S. We're looking at a leveling off here, and that leveling off will gradually start raising oil prices so that the 50s by mid-year and maybe even the 60s by the end of the year are realizable.
Yeah, I remember last time having you on that, oil was, I think, at 40 or 35, and, there were all the people on CNBC and Bloomberg saying, just, drawing a trend line and saying that it was going to go lower and lower and lower. And we were like, well, this is not sustainable. There was going to be a point where, the Saudis were the lowest cost producers and only they could survive, and everyone else was going to go bankrupt if there was an oil rally. So we didn't know when the oil rally was going to occur, but we knew that it was probably going to occur probably at least sometime in 2016. I thought it was going to be later in the year, but I guess it obviously occurred sooner. But do you think that one of the main reasons that the Saudis, Russia, Iran are increasing the amounts of oil is because their economies were doing so bad? So basically, they one of their only main sources of revenue is actually oil. So when the oil price drops, they actually have to produce more oil. It's kind of perverse. They have to make it up on volume for like budget shortfalls in their government.
Oh, absolutely. And this has been an expanding problem for quite some time. There is a significant budget deficit in every oil production dependent economy in the world. The Saudis have a budget deficit. For the first time, the Saudis are cutting their expenditures, they're raising taxes, and they're going back into international financial markets with bonds for the first time in decades. And if the Saudis have a problem, everyone else down the line in OPEC has a problem. When you turn over and start considering Russia, the Russian economy is dependent upon oil sales abroad. They're central budget is dependent upon that. And that central budget has still been calculated with the expected price of oil at about $80 a barrel, which means we're about half of where the Russians anticipated the price of oil to be when they set up this budget. There is a significant amount of financial difficulty now extending in Russia because of this. The bottom line is when you go down through OPEC, it's even worse. We have dysfunctioning economies now. Venezuela, at my last estimate, in order to balance what amounts to a budget, you can't even really tell where the budget is anymore, but to estimate where that balance would have to be, they'd need a price of about $185 a barrel to make it fit. So there's nothing close like that happening. We've got the same situation in Nigeria. And we have the situation with every other OPEC nation. It's only Saudi Arabia, Kuwait, and the United Arab Emirates that are able to sustain a budget deficit for very long. And all three of them now have it. But everyone else in OPEC, it's even worse. So we have additional production going on the market for the simple reason that you have a declining overall revenue flow and there's no other alternative. Keep this in mind, and the Iranians already know this. If you're going into an international market to gain additional export share, you can get that now only at the expense of some other country that already has that percentage. So if you're going to go into that sort of cut rate warfare, you're going to be driving the prices down even further. That's another reason why there has to be an agreement to cap at this upcoming meeting in Moscow in June. And remember, if they do freeze production, they're freezing it at the levels of production of January, and that was the highest production level in recent memory. Most of the nations cannot sustain the production they had in January anyway, so agreeing to that cap really doesn't cost them anything. Here's what happens from this point on, and this is why we're beginning to see a spike in oil prices. It's not because we have a shortage of supply. It's not because we have any major geopolitical event out there that is preventing oil from entering the market. It's because for the first time, the way in which oil is being traded has to recognize the new band of oil prices. It used to be, for quite some time now, for almost a year and a half, if a trader is going into the market, if they're buying futures contracts, or even if they're trading the wet barrels, the actual consignment of oil, if I were a trader, I would go into that market and I would peg my next price at the expected cost of the least expensive available barrel. If we were at $80 to $100 a barrel, we'd be doing exactly the opposite. We'd go into a market and we would peg our price at the expected cost of the most expensive next available barrel. You do that because you have to hedge on that side to protect your contract investment. What that does over time is it artificially either depresses or inflates the overall cost of oil in the market, depending on which way the market is going. I came up with an algorithm about 4 months ago that I use now every Friday. So I'll be, in fact, I ran it this morning. And it kind of takes out the excesses in trade. It takes out the introductions of new speculative derivatives in bridging the price between expiring paper barrels or future contracts and the actual underlying contracts of the oil that are being delivered. And throughout most of this period, for the last 8 months or so, that has shown me the effective real price of oil was $8 to $12 a barrel higher than the price we were actually getting in the market. That's how much the trading had been depressing the real effective price. As I did it this morning, we're now within $2. So we're reaching parity, at least in these figures, to where the actual price of oil ought to be based on more traditional supply and demand. It also limits the ability of traders to be able to speculate very much one side or the other. Now, we will get people beginning today and extending probably through next Tuesday or Wednesday, they're not going to be running additional shorts in the expectation that we've risen about as far as we can with this current advance in oil prices. And that may put some pressure on the overall price of oil, but there's nothing here that's sustainable. There's less play here to run shorts than there has been in quite some time.
Yeah, you wrote a book a couple years ago about how many paper barrels of oil there are in the market and how it's creating enormous amounts of volatility and really frustrating the producers to a large extent. Why do you think that Saudi Arabia is even considering doing an IPO for Saudi Aramco? Do they really need the capital that badly? Are they worried about burning through their reserves?
Well, it's an interesting point. Influential 30-year-old in the world. This is Deputy Crown Prince Mohammed bin Salman Al Saud. He is one of the sons of the current Saudi King Saud. He's the youngest defense minister in the world, and he has a number of titles, but the most important one is the chair of the Saudi Council for Economic and Development Affairs. That's the council that runs something called the Public Investment Fund. The Public Investment Fund is comprised of shares and investment value in Saudi companies. It currently has maybe $5 billion in it. It's very small. But once Mohammed decided that he was going to be running an IPO on Saudi Aramco, in which they will initially be selling no more than 5% of the company, but achieving about $2 trillion, they will be setting up overnight the largest sovereign investment fund in the world. They're not doing this because they need the additional money up front. They're doing this because this is the major stage in Saudi Arabia moving into a post-oil economic environment. They will be using both Saudi Aramco, the world's largest oil company, and progressively collateralizing the market value at discount of the oil that's still in the ground in Saudi Arabia, turning it into an investment fund. That investment fund will come to control a number of things throughout the world that have absolutely nothing to do with oil. When we talk about diversifying economies that are dependent on oil, the first thing we think of is, well, they've got to build some industry, they have to start manufacturing things to export, they have to start diversifying their labor base and so on. What the Saudis are going to do is they're going to do all of that, but they're going to allow that to be done someplace else. And their investment fund is going to control the results in any number of companies that they will now acquire. This is a major change in what it is that the Saudis have done financially in the past. And it's this 30-year-old that's going to be overseeing this.
Yeah, it's very interesting. You know, I've seen articles out there talking about how the Saudis want to invest in alternative energy, how the Saudis want to bring other industries to the country. You know, it seems to me that maybe they're trying to make some long-term plans for decades to come, that they realize, you know, we're going to have higher cost oil. You know, there's potential environmental consequences to this, that, you know, they're trying to diversify away, get more revenue. So if there isn't another oil bust, they're not caught off guard.
No, that's correct. That's correct. And there are ongoing projections by the Saudis of where the net levels are likely to be in terms of oil prices considerably into the future. They will continue to make money by exporting oil. And if they're collateralizing the oil left in the ground, even if there are changes to non-hydrocarbon sources of energy throughout much of the rest of the world, oil will remain a major component in the energy balance for at least another century, especially in Asia. Remember this, Jason. The entire focus of energy demand increases is moving rapidly to Asia. The major increases between 2040 are going to be on the Asian. That's where the real battle is going to be staged, over who actually exports oil where, over the collision between solar and wind power on the one hand and more traditional oil and natural gas on the other. And the Chinese are going heavily into this. The Chinese now lead the world in the development of next generation technology for both solar and wind power. They know it's coming. They also have more unconventional shale and tight oil and natural gas deposits than anyone else in the world. It's just going to take a great deal of money and a great deal of technical expertise they don't have to start developing it, and a lot of money for infrastructure and so on. But they know they have it. The energy market's focus is increasingly going to be Asia. Take a look. The figures just came out this morning. Take a look at where this past month of exports of Iranian oil have gone. About 80% of that has gone to China and to India. The major magnet attracting energy worldwide is Asian.
Yeah, in the International Energy Agency's demand growth figures, almost all the demand growth over the next couple decades is from China and Asia, it's from Africa, it's from Latin America, it's from the Middle East. It's not from Europe, and it's not really from the U.S. So, yeah, I think that's where all the demand's coming from.
Prices have not been controlled for some time, oil or other for that matter. The price levels and the demand haven't been controlled for some time now by either North America or Western Europe. It's been someplace else, and it's moving to Asia.
Now, I want to ask you about shale oil producers, since those guys seem to be the new swing producers. You know, the Saudis have had excess capacity, production capacity for a very long time, but the shale producers have seemed to be the really production increase. I think they've accounted for 85% of the global oil production increase since 2007.
Mm-hmm.
Why have so many U.S. shale oil producers avoided bankruptcy, in your opinion?
Well, a number of them haven't. I mean, we're seeing a widening number of bankruptcies. You got a couple of things going on here. One is you have to distinguish between the publicly traded companies and the privately owned companies. Privately owned companies are going belly up in a rapidly increasing number, and that's we haven't seen the worst of that yet. What most companies are doing to forestall that ultimate, whether they're public or private, to forestall that ultimate collapse, is they are cutting forward capital expenditure estimates. In other words, they're spending less on new fields. New technology has allowed us to gain more oil per well and per pad. We've had more wells on pads than we used to, than we've ever seen before. That averages about 17%. So the oil that's being produced in existing wells is higher and is lasting a bit longer than anticipated. Now, given the fact, especially with a shale well, that at least 85% of all your expenses are front-loaded, once you have oil coming out of that well, it's to your advantage to keep the flow going, even if the price is going down, because it is very inexpensive from that point on, and you got to recover your initial investment. So that's number one. You've had companies that have been able to produce more than they had before from the same wells. But we've had a couple of other things going on as well, and one is we've had a rising number of companies that have been selling selected assets as a way of acquiring either capital or finance to forestall the bankruptcy. There is a major move now to collect or compile a fair amount of investment and then go out and cherry pick assets for ownership. And you talk about individual wells, individual basin developments, individual land leases. We're beginning to see a pop again in master limited partnerships that control pipelines and midstream infrastructures, gathering terminals, that sort of thing. We're seeing a spike there for the simple reason that these assets are becoming more attractive. With master limited partnerships, you tend to expand only by acquiring additional assets. It's very difficult for an MLP, and in some cases impossible, for them to go out and incur debt. So the only way they maintain their bottom line is to increase assets. We're beginning to see the price of available assets increasing. And so we're having, for example, smaller pipeline systems or feeding pipeline systems, gathering locations, initial processing, and so on, being purchased by MLPs. And that finance has allowed smaller companies to continue to survive a bit longer. If we are having this conversation in November or December of this year, and if we're still at about $50 a barrel, we will have had 3 times as many companies, conservatively, 3 times as many companies go belly up as we've had thus far this year. The worst hasn't hit yet. The ability of being able to incur lines of credit in the existing circumstances is becoming more and more difficult. Even if I can go out and get a loan from an operator, even if I can go out and get a loan, I can't afford to service that loan. I'm not going to see a dramatic increase in the prices at the wellhead that I'm going to be receiving that's going to justify a 22% annualized interest rate. It simply is not sustainable. So the worst is yet to come, Jason.
Yeah, I think we've seen the oil companies raise, I think, $10 billion from Wall Street, but a lot of that money was to pay off, revolving credit facilities and stuff. It was mostly debt for equity swaps. So it was to transfer the risk from the Wall Street banks holding, the revolving credits and the junk bonds to more new shareholders, new groups of suckers, I guess.
Well, that's true, but the problem is that window is closing rapidly. Now they have benefited over the last couple of weeks because I've got a general standard out there that says, if the overall price of oil rises 1%, sustainably rises 1%, which means you got to wait a couple of days. But if it rises 1%, that translates into an average increase in equity value for some of these smaller traded companies of between 5 and 6%. They are so oversold that any improvement in the price of oil that's sustainable actually results in a higher pop in their share value than would be expected given the actual increase in the price of oil. The problem with that is that that's a declining window. You're going to reach a point, and some of them are beginning to reach this point, where their further increase in equity value is going to be dependent on even larger spikes in oil prices, which simply aren't going to happen in a short period of time. So your ability to transfer, there's still people out there interested in this, but the ability to transfer a large amount of debt into equity holdings is becoming less and less a reality. Of course, it ends up in lower and lower overall operational control as well. In better days, some of these small companies were more efficient administrators of known field assets than anybody I've ever seen. They tend to drill only where they know, only in those areas they know well. They tend only to drill the types of wells that they've drilled in the past. They know what the seismic looks like. They control enough of the variables so they can cut expenses. So at $60 to $70 a barrel, these companies were actually better investments than some of the large retail investments, average stock investors going out and looking for oil companies. These were better investments than some of the larger companies, but not at the current price. At the current price, they're getting pressured in both directions.
I have to give the management teams of many of these companies that haven't gone bankrupt a lot of credit. I thought they would have went bankrupt already. They've been able to get financing in different places. They've been able to cut their costs a lot faster than I thought they could. In terms of the depletion curves for the wells, though, do you think there's been any new technology where, these shale, I've seen the studies saying that the shale oil wells, after 2 or 3 years, a lot of them are down 85-90% in terms of their depletion curves. Have there been any of those things solved? And the other thing is, late 2015, early 2016, all these oil shares were dramatically oversold. Pretty much the baby was thrown out with the bathwater on every single one. The quality names were dramatically oversold. ExxonMobil, Chevron, EOG, those things were oversold basically just as much as the ones with the really bad debt problems. And, we've seen a short covering rally recently, and a lot of the oil stocks have gone up a lot, in the last couple of months. So it seems that we've had a bit of a rally here. Do you think this rally is sustainable? And also about the depletion curves on the shale wells? Right.
Yeah, let's talk about depletion curves first, because it just happens. I wrote something and released it this morning on this. Let's go back a moment to something I mentioned earlier, about 17% improvement in the volume of oil coming out of the ground because of technological improvements. Most of that, however, still does not translate to improving the depletion curve. On average, an unconventional shale or tight oil well in the United States will produce most of its volume in the first 18 to 20 months. And then you have a decline curve from that point on to much smaller production. In normal environments where the price of oil is higher, that's the time at which operating companies will introduce secondary and enhanced recovery techniques. They will flood wells, or they will inject natural gas, or they will use chemical additives to make that decline curve less pronounced. The problem here is that most companies still cannot do this, and they can't do this because it adds too much of an expense to the overall bottom line of running those wells. At less than $50 a barrel, it makes no sense whatsoever to go into expensive secondary or enhanced recovery techniques to be able to prolong the life of the well. What they do instead is they will drill an uncompleted well. They will cream the production off the well that currently exists. Once it starts declining, they will complete the new well and begin operations there to replace volume. But those two wells are essentially canceling out at a very early stage. That's why I mentioned earlier, you've really got to be very careful when you take a look at the number of new wells being drilled. They don't automatically translate into a net aggregate increase in terms of the overall oil available in the market. Now, in terms of what's occurring with the current spike in oil prices, there still is a considerable amount of upside potential with a number of equity positions in oil companies, even with the rise we've seen over the last couple of weeks. But it's really interesting to note, if you take a look at what were the primary companies that people would look at, the Exxon Mobils and the Chevrons of the world, for example. If you look at Exxon Mobil these days, an absolute majority of their bottom line is no longer raw material. It's chemicals and petrochemicals. And ExxonMobil, I think, is going to have a problem moving forward because, and it's not a problem. It's not going to go under or anything of that sort. But if we started getting a noticeable rise in oil, companies like ExxonMobil and Chevron will not participate in that rise as much as smaller companies because most of their current operating revenues are not coming directly from the drilling of oil. And especially with ExxonMobil, because a lot of its bottom line is now actually coming from natural gas, and natural gas prices have been depressed even more than oil prices recently. So you've got to be very selective. One of the things that we've done, this is the Energy Capital Research Group. This is the new initiative that we've started to provide real-time daily data to professionals in the industry. And one of the things we've done is we follow every publicly traded oil and gas company's net debt exposure. And we calculate which companies are likely to go under in what period of time, and which companies are likely to sustain operations, even reduced operations, at various pricing points. And what it is we found is that there are a number of smaller companies that are easily available for purchase out there by a stock owner that are likely to have a bigger pop in a shorter period of time, so long as we sustain the current gradual rise in oil prices. And the way to play that, of course, is there are a lot of very attractive options plays, short-term options plays. I'm talking about within the next 6 months, in which you either go in with a straddle or a strangle, in which you're buying both calls and puts. A straddle, you're buying calls and puts at the same price, at the same expiration date. With a strangle, it's the same expiration date, but they're different prices. And what you're able to do is actually hedge a move into the forward revenues expected of companies without actually having to expend a considerable amount of money. And that's the sort of thing I've been suggesting, along with other plays. But I've suggested a number of those plays to my subscribers in my energy services as a way of participating without committing a great deal of capital. And we've already seen several triple-digit winners in the last couple of weeks. Because of you got to understand the people who set the options market are playing the same forward game as the people who are actually trading the underlying raw materials. So if you see a change in the trading of oil itself, you're going to see a change in the way in which market makers are actually constructing this curve moving forward in options. You're likely to be able to make some money in options before it becomes evident to the market as a whole that the straight equity position of the company is improving.
Now, do you think the bottom is in for oil, or do we have to see more supply side cuts then for the bear market to be fully over and for us to, in hindsight, to say the bottom was in?
Well, I mean, the market right now is pretty much factoring in the expected supply cuts. And remember, if there's an agreement in Moscow, that's not a cut at all. That's simply a cap. The cuts are going to come from more expensive production scenarios, because we're not going to be up to, $65, $70 a barrel anytime soon. Most of that, however, has already been figured in, because those were the first forward capital outlays that were cut by companies, and that's been going on now for well over a year. We just had Baker Hughes come out again today, and we have 11 further rigs taken off the market, even with the increase in prices. We're now at about 30% of where we were with operating drilling rigs if you go back 18 months. So that's already being factored in. We do not need, I keep telling people this, we do not need further major cuts in production. All we need is stability in oil prices in order for these investment opportunities to kick in. And there you look at an investment range or band. You do not look at a specific price. So if there's one figure that investors ought to be looking at frequently every single day, it's the NYMEX strip. You take a look at the strip rate. The strip rate will tell you at any given time during the day what the next 12 months of futures contracts average into. And it's no mystery to say, well, the market's been in contango for quite some time, in which if you take a look at, you push the months out of futures contracts and the price for each of those contracts is higher than the current one. The importance, however, is how do you translate that into an investment decision that I may be making right now? And the answer to that is you need a single figure that allows you to be able to base where you think the overall price of oil is going to be and how that translates into the overall value of a stock, and that's the NYMEX strip.
Now, you mentioned the CAPEX cuts. There's been over $150 billion already in CAPEX cuts in the last 12 to 18 months. I think there's going to be a lot more than that unless the oil price rises dramatically. Even at $50 oil, like you said, I don't think there's going to be tens of billions of dollars in CAPEX investments into future projects. What do you think are the long-term consequences then from all these CAPEX cuts, 5, 7, 10 years out?
Well, normally we'd say, of course, 5, 10 years out, we're going to have $150 a barrel of oil, because that was the traditional approach. Well, that was looking at supply and demand in the traditional way, and we can't look at it that way anymore. We have much more extractable, available reserves worldwide than we ever thought existed. And that's not even factoring in yet all the unconventional oil that could be drilled in other parts of the world, but currently for regulatory or infrastructure investment reasons or whatever, simply hasn't been done. I mean, when you take a look at unconventional oil reserves, taking a look at shale and tight oil, everybody looks at the United States because we're the first ones that have been able to monetize this. But you look at the overall averages worldwide, and we're either fourth or sixth, depending on whose figures you use. There are countries out there that have far more extractable reserves than we have, but they haven't put them on the market yet. So that tends to suppress the overall spiking of oil prices very quickly, because people know in the United States, for example, we have a considerable amount of unconventional oil that could be put online in a relatively short period of time. The Russians have a wealth of heavy oil that exists below their mature traditional production basins in Western Siberia, which they could bring online relatively quickly. I'm talking about within the next year or so, if they were able to bring in massive technology and massive investment. Well, of course, if the price is at $90 a barrel, you can do that. But knowing this is all possible prevents us from going to $90 a barrel, because this all gets factored into the overall trading of oil in any given time. The net result is we are going to reach a deficit in forward financing capital, and we may well reach that by the end of this year, in which it's going to require an additional amount of investment. But that will only be translated into realizing that investment if we are looking at a price of oil in excess of $60 a barrel by the end of the year. The new balance that we use in the market is very different from the old balance. I mean, it used to be, Professor Adelman at MIT, who was the great political economist, petroleum economist of the 20th century, he used to say, look, this is a no-brainer. If the price of oil goes up, people invest more in oil. If the price of oil goes down, people invest less in oil. That's petroleum 101. Well, that's true, but less so these days for the simple reason we know there's plenty in the ground we could get if we need it. And we even have a very good idea where it is. So as a result, that's the new reality. The excess is a new reality suppressing further rapid advances in the price of oil. But it is not suppressing the overall rise of oil prices per se. Simply because it's there doesn't mean people are going to be drilling it. And that's the new reality.
Yeah, the investment in shale oil seems to be more efficient than investments in deep water where the wells take longer and there's more money and you could spend a lot of money drilling, renting, leasing out rigs, deep water offshore rigs, and then maybe hit a dry hole, and then also oil sands. So those projects seem to, going forward now, they're going to be getting a lot less capital. I think, firms like Petrobras that are higher cost have enormous amounts of debt. They could potentially go bankrupt and things like that too in the near future.
I mean, it's possible, although, Petrobras is a different issue because I was just down in Brazil. Everybody looks at their pre-salt developments offshore. And actually the structure they set up made a lot of sense and was rather efficient until you figured in all of the scandals and so on that have been taking place with the company. They have found a considerable amount of oil and gas in northwestern Amazonia. In other words, mainland oil and gas. The problem there is to be able to set up a structure that allows you to get it to market. It's rather difficult to get it out of the jungle unless you got a pipeline, and they don't have one yet. But that's essentially true. One other thing, however, to remember about offshore, we're still of the opinion, I'm still of the opinion, that at least 90% of the elephants in the world, and nobody uses the term elephant anymore, but when we used to talk about elephants, we're talking about fields that had 1 billion tons of available oil. Not barrels, tons of available oil. 90% of these or more are offshore. The last truly huge oil fields are all deep water offshore. Now, we don't need them right now because the price is lower. And it is, you're quite correct, it is more expensive to be drilling out there. But remember a couple of things. One is your average hit rate, your average volume coming out of an offshore well is much higher than an onshore well. So you tend to recover your investment much quicker. Secondly, your production curve is much higher, which means you have a spike in production as soon as you open that well, quite unlike anything on average you see on land. So you are making back a considerable amount of your investment in a shorter period of time. The whole calculus now is whether or not drilling offshore with the additional capital necessary up front is justified even with this increased flow rate based on what the overall expectations are of prices moving forward. So we have seen one interesting development, and that is keep your eye on shallow Gulf of Mexico drilling, where you tend to have the advantages of offshore but not the extended price. And in some of these areas, I remember going out south of Biloxi, Mississippi, and you could probably go out half a mile and you still only waist high. So, I mean, you've got shallow production on the shelf, which can go on much longer than in normal parts of the world. There and offshore Vietnam are the two areas in which the shallow drilling is likely to proceed at the quickest rate because it's less expensive. But you are correct. Right now, in all of the dynamics, this is not the move that people would make. You make a move like this if you've concluded that there is a certain stability kicking in at a certain range in oil prices over the next, say, 5 to 10 years, because it's going to take you that long to develop a meaningful offshore project with a meaningful flow rate.
Yeah, longer term, Kent, I don't see a way for oil production to increase without deep water, being the main driver for it. These shale wells, they just deplete too quickly. The U.S., if it hasn't already peaked in terms of its production for shale oil wells at these prices, it's going to happen soon. I mean, obviously, if the oil price went higher, maybe it would slow the depletion curves down. There would be production increases temporarily, but all the best sweet spots, the lowest cost, the best wells have already been drilled. Maybe the techniques and technology can improve, like you mentioned earlier in the interview, but I just don't see, the lowest cost, the best sweet spots for a lot of these shale plays in the U.S. have already been drilled, are already producing, and are already probably in their decline curve. And the only way long term I see this is going to be, in terms of oil production, either our demand is going to drop for oil. Maybe, Elon Musk is going to be right and he's going to sell everyone a cheap Tesla, or they're going to have to replace those oil production that's been depleted with, deep water wells. Those are the only way I see it going, in the long term.
Right. Onshore U.S., the place to be right now, and I've got a number of projects I've been looking at, is the Permian Basin. So we're going back to already established basins that have known amounts of oil available, where there's been a considerable amount of seismic, where the infrastructure is already completed, so you don't have any additional finances there, where the drilling costs are known, and where you can more easily equate a relatively expected given amount of oil production to the cost per barrel. And in that particular case, I don't see any place right now in North America that's more attractive than the Permian Basin. And a lot of people are cherry picking assets there from companies that are likely to go belly.
Now, Kent, a lot of we have different segments of listeners. We have some hedge fund managers and billionaires who listen to this podcast, big time money managers, and we also have retail investors. Obviously, retail investors can't afford to go in and go buy oil assets in the Permian Basin. What types of retail companies do you think in this oil market have good value and have the least likelihood of bankruptcy?
Yeah. Those are two completely different questions. Yeah, it's a situation in which you're looking at. Let me simply give you a couple and you have to understand there's volatility here. And so as a result, if a company ends up, spiking 10 or 12%, they can go down 20% the next week for no particular reason. And this is not like it's something that can be easily determined simply by the price of oil. You have to consider where their volume is, where they're likely to be drilling, and so on and so forth. But if I were to give two that are on my radar, one is Matador Resources, and the other is Sanchez. Now, Sanchez is more Eagle Ford than it is Permian Basin, but Sanchez also. When you go out and lease, there's a couple of projects I'm looking at right now for private investors. I may decide to go out to the Eagle Ford in South Texas and drill a shale well. Well, there are several layers you're going to go through. One, for example, is the Austin Chalk. You'll go straight through to go to the Eagle Ford. Now, that's more expensive, and in the past didn't really make that much difference. But these days, if you're going to run $3 to $5 million a well under the current climate, that becomes a more difficult decision to make. On the other hand, if you're running a shallower well, which is far less expensive, that I think is more doable. The difficulty is being able to work off the overall technical structure necessary to pull that off, and also the land leases. So here's one of the things we're seeing. Companies like Sanchez have gone down. They have drilled the deeper levels, but they also control the land rights further up, which means you can take the already existing boreholes, if you wish, and actually drill shallower wells into different formations because you control the right to do that. That allows you to drill a well where the overall expenses of the first well are actually contributing to lower the expenses of the later wells because the later wells will be higher up. We also have a situation in which companies will be drilling deep either oil or natural gas wells, actually it deals more with oil. So you'd be drilling a deeper oil well, also knowing that you've got known deposits of natural gas that are higher up. So companies have been parlaying this, and Sanchez is particularly good at doing this in the Eagle Ford. And so Eagle Ford and Sanchez and Matador Resources would be two that I would think of right off the top. And both of them are up, 40, 50% this month. Once again, there's that spike from a very oversold position.
Yeah, there was a very large short covering rally. The short interest in some of these stocks was just astronomical. I mean, like when we were talking last time, like 5-6 months ago, the short interest was just so much, and Wall Street just kept lowering the price targets more and more. And anyone who was a trend trader would just draw the chart down and, I made money shorting it from 50 down to 40, so it's going to 30 and 20. So more people, the more the trend was established down, the more people hopped on. So it was guaranteed that at some point, sentiment was going to have to reverse because trends just don't go on forever, straight down or straight up.
Right, and just to give you an example, while we're talking here, I'm taking a look at my spreadsheets. As of close today, Sanchez Energy is up 71% for the past month. I mean, that gives you an indication of what really bothers me about short players. Okay, is and I see these all the time because I'm on television a lot, and one of the things that I comment about to producers before or after I'm on the air is you have somebody, and I just collectively call these people Chicken Little from the sky is falling brokerage firm. I mean, they come on and they say, oh my God, Goldman Sachs is a good example of this. They'll come on and say, we're going back to $20 in oil. Goldman Sachs is the largest runner of short positions on crude oil in the world, both directly or indirectly. And so it's to their advantage to come on television saying the sky's about to fall, and if you believe it and the price starts going down, they've made money. But every time I meet some of these guys, I will do a briefing on Wall Street, and my favorite example is all of these guys coming into the briefing are making 7 digits a year. They're all analysts or they're all brokers or whatever. And they're all below 25 years old. In fact, one of them who made $7.5 million last year actually walked into one of my recent briefings with his skateboard under his arm. That's what we're talking about here. That's how he got there. And I've this before, and I want to tell them you've never seen anything before. You're not old enough to have an institution. Well, a lot of these people have seen the short road to fortunes on raw materials. And some of these people, ultimately, if we're getting into the $60 or $65 range by the end of the year, they're going to be going in the other direction. They don't know how to trade oil. All they know how to do is to put their thumb on one side or the other of the scales. This is this artificial element that I set up this algorithm to correct to try to figure out what the real price of oil is. The real price of oil in New York is about $48 a barrel. And the real closing price today was about $46 a barrel. So now we're close. There's less leverage for people to be able to play games. Volatility will bring in some short-term opportunities, but nothing. There isn't anybody I know out in the real business who believes that oil is going back down to the low 30s per barrel. It just isn't going to happen unless somebody is running a new derivative or somebody defaults on their contracts or something of that sort. But that's a one-off. That's not a comment on the market. That's a comment on market manipulation.
Yeah, there's been a lot of market manipulation in oil with paper barrels. I think, even the Saudis and OPEC have bought futures contracts in the past to manipulate oil prices up or down for whatever reasons. I think Saudi's original strategy or OPEC's original strategy was to try to bankrupt shale the last couple of years by knocking the price down to 65 or a little lower, and it obviously hasn't worked.
Yeah, I mean, but people have to remember what's actually going on. First off, I ran a report a couple of months ago in which we had identified a significant amount of sovereign wealth fund money coming from the United Arab Emirates and Saudi Arabia, also some from Kuwait, that were actually being used to short the price of oil. So you're absolutely correct. They've been putting their thumb down upon occasion on the unexpected side of these of these scales. But the other thing to remember about all of this is that the overall trading of oil is more dependent upon the trader's psychological perspective than anything else. When we were down, when the price of oil is really down, a trader will go into a situation pegging their price, their futures contract price, on the expected cost of the least expensive next available barrel. Whereas if we're up to $70 or $80, we're doing exactly the opposite on the most expensive next available barrel. All of this is in terms of where this curve is likely to be moving forward. If you are persuaded that there is a stability in the band, now the band can, be moving several percent in either direction, so it's not simply stagnant. But if you've come to the conclusion that that band is essentially sustainable, there are very little reasons why it is that you're going to be speculating too much in either direction on oil. Remember, if you're running, and this is true whether you're running paper barrels, whether you're a producer of oil, whether you're an end user of oil, whether you're a transporter of oil, everybody is hedging their contracts. And to hedge the contracts, you are going to take out insurance. And the insurance is options going in one direction or the other. If I'm in a very volatile situation and I'm not certain where the price of oil is likely to go, the preponderance of my option insurance is going to be in the current expected trajectory. So if I think oil is going down, that's where most of my protection is going to be. If I think oil is going up, that's where most of my protection is going to be. If I think that it's, the Goldilocks approach, not too high, not too low, just about right, I don't have to have a great deal of insurance to make an adjustable profit. That makes a more realistic price in the market, and it also allows traders to make a sane amount of money off of this without having to gamble in either direction.
Yeah, and those Goldman Sachs, those 25-year-old Goldman Sachs traders, I don't think they understand how to hedge and do all these things yet because they haven't seen bull markets and bear markets. They've only been around for a couple of years. They've probably only seen markets in one direction.
Yeah, and they've seen markets that have been manipulated, essentially. I'll tell you the other thing, too. When I used to be a university professor, I retired 2 years ago, I used to force my graduate students to do things that no one else does. If you're trying to figure out implied volatility to run your options, what you do these days is you take out your handheld calculator and you push an app. That's it. And I'd force my graduate students to actually calculate these, what it means to calculate an implied volatility. And what it is they'd find out very quickly is that there are 11 major factors that go into determining volatility before you can estimate an options price. Absolute majority of these, 7 in most cases, are elements that don't normally apply in the actual trading of oil, which is another way of saying that the great formulas upon which our entire options industry is based don't work most of the time when you apply them to a commodity like oil. And people realize this if they actually have to crunch the numbers themselves and then compare the numbers to historical figures. They just don't compute. If you end up with with like a 22% variance, it's worthless. And that's what you'd get most of the time. So you have to have a different. It isn't simply hitting an app. It isn't simply working out an option spread. If that's all you do for a living, you probably can make a decent living. But you're not correctly estimating oil, and you're not correctly determining what the best moves are with the biggest pops for normal investors.
Well, Ken, I just want to thank you again for your time. You've been a wealth of information about the oil and natural gas markets. If our listeners want to check out your articles and your newsletter, how can they do so?
The easiest thing to do is to go to the free service. I have 6 services, but one of them is free, and it's an access to everything. This is www.oilandenergyinvestor. It's all one word, oilandenergyinvestor.com. And that will have the archive of all of the free briefings I do and all of the reports that have come out.
Great. And hopefully there's a little bit of a pullback, a correction in these oil stocks, some of the better names that you talked about. And, our listeners who missed out on this oil rally can maybe think about adding positions then.
Right. Absolutely.
Okay, great. Well, thanks again for your time, and hopefully we'll have you back on again in a couple months.
Absolutely. Looking forward to it.